Joel Schulman, what are you seeing in terms of investors preparing for what could be a rocky macro story in 23?
Well, I mean, the investors are certainly focusing on the interest rates and what's going to happen in the next Fed meeting and inflation. And I think inflation's been the narrative throughout 2022. We're going to see it continue through next year. As your guests point out, I mean, the import-export data that came out today is part of the GDP, growth. Is, I guess, not surprising considering the soaring dollar. So the soaring dollar provided a temporary respite for exports going up and imports going down. That buyer behavior doesn't change that much in the short term. So we saw an unusual pattern when the markets when the markets start to reflect that dollar change, it's going to revert to exports being more expensive and imports being cheaper, and we'll see that reverse. I think going forward, the inflation data, which is going to continue to come in, with CPI coming way down, particularly as housing's getting hammered. We're going to see housing drop quite a bit. And probably in a few months, we'll see the readings come down. But that's going to be, again, as you've been saying earlier this morning, in the rearview mirror. We're going to be seeing inflation coming way down. And the important thing is, when you talk about employment, we got 79 million baby boomers, many of whom are reluctantly working. All right. And so when we pull them out of the system, it's going to help our unemployment numbers. The other thing that's not been mentioned is many of the layoffs. So the tech layoffs are many times these H-1B workers, these temporary foreign workers who are in the tech areas coming from foreign nations around the world, particularly from Asia, and they're not going to hit the unemployment numbers. This is another important statistic that a lot of people, I think, may be overlooking.
Joel, is anybody investing around these worries? I mean, we're here talking about this rail strike potential because this is going to be a huge impact on the economy. You think we're weak now? Yeah. Wait till the rails go out of business. Or the people
what's interesting is we're seeing markets. Yeah, we're seeing markets actually respond relatively well in the last month or so, and particularly in some of these risk categories. Now today, of course, we're seeing a big hit in the cloud stocks with CrowdStrike coming in poorly. But otherwise, we saw the areas, for example, some of the riskiest areas like Chinese ADRs have one of their best months in years. And so we're seeing some return to the markets largely on the narrative of inflation. Now, no question about it. The rail strike, if it happens, would bring the economy to its knees and certainly going to drive our GDP down. And we're going to see some real problems with continued supply shocks.
Oh,
but
God. Wait a second. Are you, if you want to get us fired up even more, are you suggesting we buy Chinese ADRs?
No, not at all. Not at all. No. Okay. I'm not. No. Okay. Not at all. And I'm saying stay away. But we've got to. Not at all. I'm not buying them. So, but the point I'm making is that there is a return of risk capital. Now, some of it could be, for all we know, it could be a transfer of other risk capital, which I would consider akin to Chinese ADRs, which is a crypto. Some people may be moving. They may be sliding money from one risk category to another. That that could happen. I'm just merely saying that we're seeing a return to some risk categories. I think that the tech stocks in the U.S. could be one of those areas that's an interesting narrative in the way that inflation is coming down, and it has gotten hurt when inflation went up. And I think the narrative when inflation comes down is going to be helpful. And I think when we see the Fed pivot with a 50 basis point, it's already been expected by many investors they're going to come at 50 basis points. They may signal that in the future they may scale back because they're already going to be fairly close to their levels. And we're going to see in 2023, as bad as many people suspect the economy to be with GDP slowing down, we are going to see we are going to see unemployment stay relatively muted because, again, we've got 10 to 20 million baby boomers who would like to retire. They just can't because inflation's been high and because the market has hurt their portfolios. So
isn't this rally getting ahead of itself, though? I mean, look, the Fed, suggested that maybe, they're going to slow down the size of the rate hikes, but nobody said they're stopping the rate hikes anytime soon. And yet you got a market that's up in the month of November.
Right, and by the way, I may be in the minority in this group, but I think we're going to have a Christmas rally. I really do. I think after December 15th, the market again is already anticipating some of this 50 basis point, but I think they may signal that next year they're going to scale back even more. And I think we're positioned very well. And again, I know I'm a minority opinion in this group, but I think we're going to have a Christmas rally.
Well, I never said I don't expect a Christmas rally.
I never underestimate the recklessness of intoxication over the holidays. So maybe so, Joel.
Yeah. But Joel, this is interesting because Powell gets out there, every few weeks, every month, and talks tough, and he talks tough, and markets just, I don't think, buy it. If we see an end-of-year rally, it's because markets think whatever Powell says today, he really doesn't mean it. How does the Fed operate on the basis of zero credibility when they want to get tough?
Well, I think you raise an interesting point. I think we had a couple setbacks. I would have anticipated when CPI came in, the last couple readings, it would have gone even more, but for the last CPI reading was the first one that was good. Prior to that, we had some hiccups with OPEC and other things. We had other issues that were affecting the markets. I think. But for OPEC and but for some other things, oil's come down. Many of our commodity prices have come down. China's scaled back in terms of their production with COVID and other things. So we're going to see, generally speaking, prices have come down. Now, as a result, we're going to see inflation, particularly with housing, which we all know is a lagging indicator. When the CPI comes way down, and if housing actually starts dropping in CPI, we could have CPI dropping well below 5%, into 2% or below, with housing coming in, perhaps negative in about 5 months.
That's a question I want to pose to Joe.